In the best tradition of New America, today's panelists represent a broad array of perspectives and will offer some very different prescriptions for recovery. We'll try to establish some common principles among the panelists' suggestions, but at the end of the day, we'll leave you with a pretty wide range of recommendations for how the Obama administration, Congress, and leaders in the financial sector might get things back on track. Our first panel will focus on the economic stimulus legislation that may come up for consideration as early as next week. As you know, President-elect Obama has indicated that whether or not Congress takes action this year, one of his early priorities will be another stimulus measure. Our experts will analyze several of the initiatives being debated for inclusion in the package and whether, more fundamentally, government should be in the business of economic stimulus. Moderating this panel will be one of the preeminent figures in the world of federal budget policy, former Congressman Bill Frenzel of Minnesota, co-chairman of the Committee for a Responsible Federal Budget. At lunch, we'll hear from former Michigan Governor John Engler, now the President and CEO of the National Association of Manufacturers. In his current position, Governor Engler consults daily with those on the front lines of America's economy. His members have already felt the brunt of the slowdown and the credit crunch, and their very existence, in some cases, depends on a rapid recovery. The Governor will lay out NAM's proposal for a 25-year infrastructure investment strategy to create jobs and increase the competitiveness of U.S. manufacturers. Our second panel will take a hard look at the financial markets. What went wrong? What changes are necessary to restore confidence and unfreeze credit markets? How the $700 billion that the federal government has committed to rescue Wall Street is being spent, and what the era of the trillion-dollar deficit will mean for budgeting and fiscal policy going forward. So we have a great day, and if you'll excuse the pun, some very stimulating conversation ahead of us. To start things off, it's my pleasure to introduce our morning keynote speaker. Since he founded Medley Global Advisors 20 years ago, Dr. Richard Medley has been one of the most astute and prescient analysts of macroeconomic trends and policy in the country, ably synthesizing politics and economics in all of his work. More recently, he founded a hedge fund that anticipated the credit crisis and as a result remains a strong force on Wall Street. As we enter this new era of both collaboration and hostility between Washington and Wall Street, few analysts are better positioned to offer a credible assessment about both sides and about the context in which regulatory and macroeconomic policy will be reworked, not only in the U.S., but globally as well. Dr. Medley is chairman of Medley Capital, a growing family of separately managed funds. Medley Capital also manages A.W. Jones International, the first hedge fund ever established, which has a 58-year track record of 14% plus annual returns. Prior to forming Medley Capital, he founded Medley Global Advisors in 1997, where he developed a network of more than 250 full-time and part-time intelligence sources around the world. In 2005, he sold MGA to a consortium of private equity investors. Before MGA, Dr. Medley was a partner, managing director, and chief political advisor of Soros Funds Management. Dr. Medley is no stranger to Capitol Hill, having served as chief economist for the House Banking Committee and for the Senate Democratic leadership. He has a PhD and 2 master's degrees from Yale University, where he also taught political philosophy, and is a life associate of Calhoun College. Dr. Medley is a lifetime member of the Council on Foreign Relations and served in the U.S. Air Force. Please join me in welcoming Dr. Richard Medley.
Thank you. A couple things to start. Whenever I hear the long version of my resume, it just makes me think of 2 things. One, I'm really getting old, and I just don't know how to keep a job. I think those are the 2 lessons. You know, owning a hedge fund 2 years ago, you'd walk in and people would say, wow, that's really interesting. And now they kind of look at you like, it's really too bad. I get treated better at customs, I think, is the only real advantage to that. But I was down here for the IMF meeting and was sitting with a friend, an old friend who's very famous, but whose name will remain anonymous for the purposes of the story, which you'll realize in a second. And we're sitting around at a table like this with a bunch of people from Kuwait and Iran and places like that, Saudi Arabia. And this guy completely It was right after it was after the $750 or billion bailout was announced, things like that. And with a complete straight face, he says, well, now I can go home. And everyone at the table kind of looked, what do you mean you can go home? He goes, well, 40 years ago, the KGB sent me here to socialize the United States. I've now completed my task, and I'm free to go home. And I do think that's the context of these remarks. I'd like to break them, and they'll be very brief, into two sections. One is to talk about what is happening, and not what has happened, but what is happening and was likely to happen within the financial service sector. And then quickly to outline a couple things that I think the regulatory authorities could do in short order to help usher in this new era. I just finished an article, and it's in this next month's Esquire magazine, called "What Just Happened," and the opening line is something that I felt and found my hedge funds on the principle of, which is that free money makes you stupid. And it's been repeated over and over and over again in history. Once you get money that you can use essentially for free, you're going to end up doing pretty stupid things with it, just because why not? You can do it and you can get away with it. As I said in the article, there was a time in Mexico City where the money was so free you could get kidnapped and still turn a profit. But the basic essence of what happened is that the adults lost control of the situation. And the adults lost control of the situation because they let people start to put on trades and start to do things with their money that they didn't understand. And once you lose adult supervision, especially with billions and billions and trillions of dollars at stake, it will go wrong, and it, as we all know now, it did go terribly wrong. The real key to where we've been is that we've now changed the essence of the American financial system for at least a generation and probably longer. I think we're going to end up going back to a much simpler financial situation, one where people do things that are more in the historic provenance of finance. That is, that they lend money to people who can afford to pay it back and who need it. And they don't lend money to deadbeats. And that's going to change a lot, because that means less leverage. It means that banks will grow at an amazingly slower speed, but they'll be more solid. It means that the hedge fund industry will consolidate significantly. I mean, the hedge fund industry is going to shrink very rapidly over the next 2 years, and certainly over the next year, for two reasons. One is that the hedge fund industry is built on getting money from other people to invest for them, and there's less of that out there. So people are withdrawing from hedge funds, even hedge funds that are doing well this year. And about 10% of the hedge funds like us are up for the year. But even those funds, people are having to withdraw from because they've been hit by withdrawals from their own investors, or some foundations, for instance, have lost so much money in private equity and other strategies that they're having to withdraw money so they can make the payments out to people that they need to do to keep the tax-exempt status. So there's a kind of a snowballing effect on the hedge fund industry. But it's also really good, because the hedge fund industry had gone from, when I first joined Soros in 1986, it had gone from, there probably were 50 or 60. At the beginning of 2008, there were 13,000. And one thing's clear is that there weren't 13,000 hedge funds worth of talent. And that accelerated the collapse, because people, particularly in stock markets, one of the reasons that emerging markets and stock markets is down so much is that everyone was there. A lot of the funds, I don't know, I can't quantify this for you, but a significant number of funds who were in like strategies like long-short equity or arbitrage or what was called market neutral, and people should have been using air quotes on that all along. We're all in the same trades. So when Korea started to go down, and you have risk limits as a hedge fund manager, you had to get out of Korea, but everyone had to get out at the same time, and there's only about 15 stocks that trade in Korea. So it takes the stock market down 65% in about 2 weeks. Not on fundamentals, but on markets, but because markets had to exit. So taking the number of hedge funds down is going to be a very good thing, because it's going to re-diversify the kinds of things they do and increase the talent pool for the surviving hedge funds. Likewise, taking down the investment banking sector and forcing it to reinvent itself. And that's not at all clear where we're going with that. Because remember, investment banking, the reason investment banking was around basically was as a fee-based service. It did things for money. It sold bonds, it sold stock, it bought bonds, it bought stock, it gave advice, it did mergers and acquisitions, things like that. And its income were based in fees. Over the past 5 years, that got enormously distorted, and its money came mainly from financial engineering. Its earnings came mainly from financial engineering. So I saw this morning on the way down that there are now estimates that there will be something like 75,000 jobs lost in the investment banking industry just in the U.S. Over the next 2 years. And, you know, who knows? I mean, it's anyone's guess, but that sounds reasonable, given that so many of these jobs were created to pursue more like financial engineering than they were the traditional things. It also means earning margins get compressed at things that were called investment banks, and now, except for Lazard Frères, I think, is the only remaining large-scale investment bank in the United States. But the things that have converted into banks, they're going to have to figure out how to make money now, and it's going to be more fee-based, so they're going to grow slower. You're also going to increase the number, you're going to have a boomlet in small banks, in the creation of small banks, because you've stripped the provision of credit from a lot of communities around the country right now. And there's a real opening, and I know this because one of our hedge funds is essentially what used to be called a non-bank bank. We make loans the old-fashioned way and hold them till maturity and all that silly stuff. But there's an enormous vacuum for people who need something like, you know, businesses that need 5 to 50 and even up to $100 million now. There's a huge vacuum there, and it's likely to persist for quite a while. And that's going to create a vacuum like that in the financial markets creates someone to fill that vacuum, and it's likely to reproduce a kind of old-fashioned feeling American banking system that we've, you know, collapsed, shrunk down to 4 banks. Will start to re-expand, but in a small and relatively unnoticed manner until it gets large enough to report on. But that's going to start to happen over the next couple of years, and the banking laws are going to have to allow that to grow, and that's part of the thing the Obama administration is going to have to wrestle with. But there's 2 things I'd say and then I'll finish it, going forward that regulators, I think, need to think about. One is, I would say very strongly, take a deep breath. Because regulating in the midst of a crisis is a disaster, is a recipe for disaster. And I don't mean a deep breath like a 45-year breath. I mean a deep breath like 18 months, 12 months, something like that. So you kind of see what's really happened to the financial system, because we're still in the middle of it. You know, we're kind of in the early middle stages of the recession. We're in the middle-late stages of the financial crisis. We haven't gone through it yet. We haven't finished it. We don't know how this is all going to shake out. And trying to regulate too quickly into that, you're likely to, to regulate the problems, or to unregulate problems that will need to be fixed and overregulate problems that are already on their way to being fixed. You know, the principle of Occam's razor, which says the simplest solution is often the best, or the simplest way of thinking about things is often the best. One thing that's very simple that should be done and should be done as part of any re-regulation is to limit leverage. And the reason that leverage is important is not just for the obvious. If you don't have 1,800 times your balance sheet out there, it's harder to get in trouble. It's because the only way these very complicated arbitrage equations and risk tranche sell-offs get going is if people can leverage that, because what you're doing is you're presenting the company with a proposition that will make a very small amount of money on every one of these little transactions, like 1 basis point, but we're going to make tons of them because we're going to take our leverage up to 40, 50, 60, 70, 80 times the capital base of the firm. And we can justify that because there's nothing really at risk. And that was the sale being made across America and across the world over the last 4 years. If you don't have access to 40, 50, 60, 70 times leverage, you can't even start to make that sale. And as you know, we were showed in the 80s here with the leverage in the U.S. stock market that created derivatives that led to the 87 crash, as we've shown again here in 2008. It's the sense that you get out of control in the kind of instruments you think you actually understand, but you think what you've done is hedged yourself off from risk. But as Jerry Corrigan, the former New York Fed president, said, you can't hedge the world. And if you get away from thinking you have hedged, it helps keep a balance to the system that is necessary. Now, you grow slower. You have fewer pockets where you can go and dip in for free money, but you grow on a more sound and solid footing. So I think leverage limitations as a kind of a node point of controlling what goes on in the future are a very important thing to be considered by the incoming administration. So, yes.
Great. Thank you, Richard. Why don't you stay up here, and we'll open up to Q&A. We've got a mic, so if you could raise your hand, and we'll got a questioner up front.
Hi, I'm Morton Kondracki of Roll Call. What would constitute overregulation? I mean, what do you see on the horizon that constitutes overregulation? You mean what? Is that a hypothetical? No, Congress and elsewhere in the discussion makes. What would constitute too much regulation that would stifle enterprise? Well, I think trying to get too decisive about exactly what form the financial structure should take coming out of this would be a big part of overregulation. I think that some of the ideas that Sarkozy and others are proposing in terms of a kind of transparency that would actually make it almost impossible to. There's a level of transparency that's necessary for regulation. There's a level of transparency and then that makes it actually impossible to do what you're supposed to do as a business. I'll give you an example from the hedge fund industry. And we're going to end up wrestling with this because we are going to end up being regulated, and we should be regulated. But one of the things that would be the difference that would drive people offshore or into hiding is if we were forced to disclose all of our positions to the publicly. The very essence of, for instance, the macro fund is that you hold positions you don't want other people to know you're holding, because if they do, they then go after you in either a short squeeze or if you're short things, or go after you on the long side if you're long things, particularly as you become a bigger target. So you have to be careful on predefining what the meaning or what the reality for the new financial services is going to look like. Whether there should be new savings and loans, like mandating savings and loans, or mandating. Let the system kind of move and gravitate toward where it will before you then start to regulate what comes out of that. And I think that's really going to be the. I hope that's the approach that's being taken. I get the sense, at least in the United States, that this take a breath notion is pretty strongly embedded now, because it's I don't hear a lot of rush to judgment. There's the Post has an article about something that very few people noticed that happened in August, with a big change by the U.S. Treasury on a tax policy relating to takeover to acquisitions. And there's some real debate, I guess. I mean, I'm not a tax lawyer, but it appears to be real debate about whether the Treasury had the authority to do that or not. But there's also real reluctance among people on Capitol Hill and others to even kind of talk about that very much, because you don't want to undo some of the mergers that have taken place, and et cetera. So you don't want to cause more trouble for financial
institutions than they're already in. So I think the pause is going to take hold, at least in the United States. I can't say the same for Europe. I think they're going to move toward harder and tighter regulations of financial institutions across the continent.
Right here, ma'am. Faith? Okay, we'll come to you, ma'am.
Hi, Dana Chasen, OMB Watch. Two very quick questions. You can address either one of them. You seem to underscore deleveraging as something that would be at the heart of the next generation of financial sector regulation. Other than a capital adequacy approach, I think you said something about actual restriction. I think that was the word you used, restricted leverage. So if you could amplify what forms of restriction you imagine the next iteration might take, that would be interesting. Also, I wonder if you have an interpretation of the extent to which the Treasury Department is using the TARP legislation to restructure the banking sector, perhaps along the lines that you were describing, but it seems as though lending is not occurring following the infusion of whatever it's been, 165 billion so far to the, several dozen financial institutions. Along with the August tax measure that you just referred to, both of these seem to encourage consolidation, restructuring, M&A. Is that appropriate? Is it helpful to economic recovery? And is it consistent with your vision for what the U.S. banking sector should look like?
Let me just take those quickly in reverse order. I think the problem with the reason you're not seeing any lending, there's two reasons. One is that there were very big holes that needed to be filled in these financial balance sheets, and some of what TARP has done so far is going to fill some of those holes, and some of what else the government has done, the Fed and others has done. I mean, but as you see with AIG, sometimes you don't even know how deep that hole is, and I think that's the biggest problem right now, is no one knows how deep these holes really are. For instance, in one of our funds, we get approached all the time to buy portfolios of loans, and at not unattractive things, at 60 cents on the dollar, or 50 cents on the dollar, at prices that in normal times you would say, thank you, thank you, thank you, thank you, thank you. But at this time, you don't know whether that's really 60 cents on the dollar, whether you're going to turn around and in 6 months or a year, it's going to be 10 cents on the dollar. Because until the housing market, and there's this chain reaction that needs to get started. This is what I think people are coming around to and what they need to come around to. Until you can get the housing market started, until you can start to put a floor under the prices of those securities that everyone says are toxic, but that word is one of those words that gets used without being understood, and it's good enough, because I'm not sure anyone understands it. But it's the whole bunch of these securities that just can't trade in the markets right now. Once they start to trade, and we saw this in Japan, once the Japanese government stepped up and started to make a market in the NPL, the non-performing loans of Japan, hedge funds and banks came in and started to make their own market in it. Once they knew there was a floor, then they could start pricing these things. You can't price these things at this point. And as we've seen Warren Buffett, it comes in and tries to, catch the falling knife, and he's laying down now. I mean, there's no one person that can catch this knife, and there aren't enough institutions. Goldman Sachs, 2 years ago, if they came in and said, we're going to go in, and together Goldman Sachs and Warren Buffett are laying down. So you need to have the federal government step in and start to make a market in this through the Fed. And there's a bunch of tech, and I'll be glad, Dana, to talk to you off, but that's what needs to happen. There's a chain reaction. Once that happens, then funds and other institutions will come in, and they'll start to buy up these things. Then that will really tell banks what the hole is that they have to fill. And it'll begin to tell them they can make loans again against something they can value, against something they understand they can value. I mean, we're one of the best private bankers banks in the country has started to try to do that a little bit in California through a process. I mean, this is how bad it's gotten, where the prices in Southern California homes have come down so far that investors are coming in and buying the houses on the condition that the people who are living in them now and own them re-rent them from the person who's buying them. Because the cap rates, as they're called, are so low that they can make money charging these people who are going to live in there an affordable rent that the people who are living in them can afford. They don't have to move. This guy's got to, but he can. That's how low some of these prices are already, and that's that's actually. I mean, it's a very small, plug in the bucket, and you can't do that systemically nationwide. But it shows you how low things have gotten and why people are afraid they could go lower.
Great. We've got time for one last question.
Gillian Garcia. The U.S. has a dime a dozen of regulatory agencies, whereas much of the rest of the world is moving to a Twin Peaks system of a prudential regulator and a separate consumer regulator. Before the crisis really hit, a lot of organizations in the United States, including the Treasury Department, had a proposal for a regulatory realignment. What do you see for the future of regulation in the United States?
I think we should just turn it over to the EU. I think we're going to be driven toward some form of consolidation of regulation. Again, it's one of those things that I hope we're years off from doing because we don't know but I think we're going to be driven to that. Now, I do think that it's not a magic, it's not a magic bullet, because what was clear was even the agencies that understood what was going on didn't understand, or thought they understood what was going on, and didn't understand what was going on. And I'm not sure, as we've seen with Homeland Security, that one czar of regulation is going to be the answer. But I think you're going to move toward that because you do need to have these groups working with each other more closely. And we've tried it a couple of times. I mean, that's how the Comptroller of the Currency got created a long time ago. It's even how the Fed got created in 1913, with the design of having one group to start to look over broad swaths of American financial services industry. And I think you'll move back toward a more consolidated structure of that, but I think it'll take a long time to get there.
Well, thank you, Richard. Please help me thank Richard for those very insightful remarks. A great start to today. Thank you, Richard. If we could have our panelists for the first panel come on up.